much for tuning in to Talking Point. I'm your host, Nirav Sheth. The Talking Point today are the views of Nirav Sheth, who joins us at an opportune time, considering that we are now in the fifth dip for the global markets. And as difficult as the question is whether the dip will get bought into, we'll ask Nirav that. We'll also talk to him about what could the repercussions of the next 10, 12 days be, which are where we have a bevy of central banking meetings, and the decisions or the commentary thereof could well have a bearing on how the market perceives the next few weeks to be like. Nirav, great having you. Thanks for joining, and I hope all is safe.
Likewise, it's a pleasure talking to you always.
Thanks, Nirav. So, Nirav, the PBOC set the tone, if you will, of trying to show that much contrary to the belief of most people, it might well be China which will come to the rescue of the world economy yet again. But that notwithstanding, we also have the RBI meet tomorrow. We have the Fed meet on the 15th. How important is this whole central banking fortnight for equity markets?
It's fairly important in a sense that, different parts of the country are facing different problems. So at least the bond markets in US are telling you that stagflation seems to be a problem. It's very difficult to take a call on inflation because this is the confluence of both the demand side factors and supply side factors, right? So far, the inflation expectations are very, very well anchored in US, and therefore you hope that things are not out of the way. I'm slightly worried about what's happening in China. In a way, it's good for the world economy because some sort of slowdown in China is essentially a disinflation impact, which is obviously the biggest problem right now for large parts of the economies. China problem is not very easy to solve because to me that is ILFS squared to the power of 4. Property investments is and allied activities is close to about 28-29% of the GDP, and it's a big cycle because the provinces sell the land, the builders buy the land, there is speculation in the property markets. You eventually cannot force the consumers to go and buy the residential properties. It cannot be tweaked by sort of tweaking CRRs, SLRs, and the reserve rates. So China's got the firepower finally to bail out a lot of the builders in problem, but it's going to be some sort of a bell that is going to hang around the neck for a long, long time. India, I am fairly constructive that RBI will continue to maintain accommodative stance. Just think of this, Neeraj. The manifestation of liquidity eventually has to reflect in credit growth. Why in the hell would you raise interest rates if my credit growth are at decadal lows, right? So as long as you believe that they can talk the inflation down, which is largely credibility of the central banks, right? If you manage, and they've done it extremely well over the last 2 years, then I believe that they will continue to sound hawkish, but I don't think they are going to temper anything with whatever you want to call it, excess liquidity. Yeah, 8 trillion, 3 trillion, 4 trillion is just a number. What you are worried about is the outcome of that. That is certainly not interesting.
So you don't reckon that the Fed, as different as its tone sounds now compared to what it was, say, even 2 months ago, will do too much of a heavy tinkering? It will be in line with expectations.
The good thing about Fed is that any central bank saying that I'll be ahead of the curve in terms of tackling the inflation is a good thing at the end of the day. What you're essentially worried about is that market forcing Fed's hand to do something when it figures that Fed is behind the curve. I think that's a very, very good thing in terms of what Fed is doing because a real Armageddon scenario is Fed losing control of inflation, because then you will have a sell-off in equities, you will have a sell-off in bonds, and you really don't know where to go, right? So that you don't want the situation. And I think that whatever Mr. Powell has done is extremely, they'll do what is right, and the economy is firing. So I'm not too worried about it. I think they'll be able to guide the markets fairly well.
So Nirav, we showed this chart this morning that on trade setup, that there have been 4 instances in the past wherein the mini corrections have been bought into very, very swiftly. In percentage terms or in the movement terms or in the trend line terms, we are right at the cusp of that mini correction. Do you reckon this might get bought into? Is it possible to predict that, or is it difficult to predict that?
If I was running a $10 billion fund, I'll buy into it, and I'm hoping that given what the trajectory of the profits are, given where we are in terms of very early stages of economic cycle. I suspect there is a bull market correction, and if my hypothesis is right, I think these dips shall be bought.
Okay, so it may well happen. You're saying that there might be a bit of a more downtick, but you are effectively a buyer into this dip if you can.
Absolutely, you cannot. You can never time the last 2 or 3% or even 4% for that matter. But I'm talking largely now on the behalf of institutional investors. When you want to put in billions of dollars into work, you're not looking at that one point of day where you're going to buy right at the bottom of the markets.
So Nirav, you obviously speak to a bunch of these large FIIs as well. The bane for the market, the resurrection is probably the retail power, right? And we've seen that ample evidence of that in India. But the bane seems to be the quantum of FI selling that has just plagued us in the last, of a few weeks, if you will. What's the reason for that? Do you reckon that will continue? Is it a December phenomenon? Can you talk a bit about that?
Well, you speak to different people, you get different answers. But I reckon that we were a serious outlier in terms of outperformance as compared to other EMs. And therefore, it is natural that if you are seeing some sort of headwind in terms of what is happening to the global trade cycle, then you're trying to take some chief off the table. And that is probably what is happening. And even the fact that obviously, FIs are fairly overweight on the banks. Banks is a large component of Nifty, and therefore you're likely to see a lot of selling happening in some of these large caps. But like I said, I suspect that we are in the last leg of that relentless selling that has happened. And it seems to me to be a year-end phenomenon. Obviously, you do hear about the fact that there are concerns about fintechs and stuff like that, whether they can disrupt the Indian banking system. And stuff like that. So there are a lot of micro factors, but I think the overarching macro view is that if Fed is raising the rates and if the valuations are at least 1 sigma deviation above mean, then you want to take some chief off the table. At least that is my reading.
Okay. So, typically when the FIs are on the selling side, banks tend to underperform. There has been a bit of a downward move. Valuations are a bit more reasonable than what they were maybe a couple of months ago. Where are you on this argument for whether banks will lead whatever move happens over the course of the next 12 months, or will banks be the sideshow and it will require a special effort from maybe industrials, Reliance thrown in, maybe IT continues its upward journey? How do you reckon the mix will be of the next up move whenever it happens in the next 24 months? Would banks lead it, or would banks be the sideshow?
Even where the banks are in terms of their absolute valuations, in terms of the relative valuations, I would strongly make a case for banks leading the rally. Even take a 30,000 feet view. What are banks finally? They are a leverage bet on the economy, right? And if you believe, and if our hypothesis is that India's balance sheet is going to look far different in the next 3 years from where it is right now, the government balance sheet, the corporate balance sheet, the investment cycle, then I see no reason why banks cannot give you outsized returns, simply because, like I said, I'm again coming back to the point that they are a leverage bet on the economy. Also, please appreciate the fact that, most of the banks, we are talking about the large private sector, large PSU banks, that are carrying excess provision on the COVID. We don't know how that is going to play out, but they're very well capitalized for that, which means that at some point of time when things normalize, you are going to see a lot of the write backs happening as well. So I would say there's a 90% probability that earnings in the banks are going to hold up. If I remember right, we are looking at 50% increase in profits in FY24 over FY22, right? And if banks don't run up, I don't know what else will drive their share prices up. I'll be very surprised.
Okay. The other conundrum, Nirav, if you will, is the valuation discomfort that some people have with technology stocks, and maybe in certain cases, rightly so. Some of the mid-cap names have eclipsed the large caps by a margin. But when you speak to bulls into both large cap and mid-cap IT, they make a case of this whole digitized world of how mid-cap names, or rather the non-Nifty names, are promising growth for the next 2-3 years to the CAGR of 15-20%. And therefore, why shouldn't people bet on them? I want to understand from you both sides of the argument. Why is it that you would be bullish if you were bullish? And if you are not bullish, why is it that you are skeptical of further up moves in IT?
Right. So I am neither, bullish. I don't think I consider myself bearish as well. Sometimes you can argue that the markets are efficiently priced. Most of the times they are. But here's the thing. The thing that you want to look at is that what are the long-term growth rates in the software sector, right? So, and if you broadly, look at the growth rates of the global outsourcing market within the market share of the India, and within that how the top, the large cap companies, small cap companies are going to grow, I would augur that they will grow at about 6 or 7%. Right? When you are talking about 6 or 7% growth in free cash flow, because the free cash flows are very close to the earnings growth rate, then that the terminal P is going to be in the region of 15 or 17 times. Right? Now, what has happened is that you are fairly excited about what's going to happen in the next 2 or 3 years. I don't have a great call in terms of what is going to happen over the next 2 or 3 years. But the only reason for stocks to get re-rated and remain re-rated if you are permanently increasing the terminal growth rates. I am not buying into that argument, and therefore I believe that you are at best likely to get required rate of return. In most cases, I suspect that it will be below market returns. And somewhere probably I'm also biased from the fact that I'm fairly bullish on the construct of the Indian economy, as I've talked about, and which means that you are going to get surprised in terms of how rupee is going to behave over the next several years. I won't be surprised in the next 2 years rupee will remain where it is today. That is going to remain a serious headwind, because a lot of the pricing that the software companies do, there's an implicit 5% depreciation that they're building. But let's see how this plays out. But I am not the one to put, certainly not to go overweight on the software stocks right now, and certainly not on mid caps.
Yeah, but you're making a bearish argument, Nirav. You mentioned that you're not bearish nor bullish, but you're making a bearish argument of sorts.
Yeah, because I think once you spend enough years in the market, you know that you can go wrong. It's not very easy to foresee things that are happening in parts of the world, right? So we need to be more humble, I guess.
Okay, fair call. What are you bullish on? You mentioned that you're bullish on the economy. Are you therefore constructive on the economy facing businesses wherein maybe even the valuations are a lot more comforting, and if the cycle is good, then margins, ROEs, etc., all of them expand, and therefore not only will there be earnings growth, but there could be a valuation re-rating as well, or what else?
So, it's not necessarily a top-down view, but, because I made a lot of companies, I've been trialing quite a bit over the last several months and all. But everything. So, for example, look at consumer discretionary, right? So, from autos to consumer durables, you look at the entire gamut of the companies that have been impacted by now the well-defined template of PLI. Look at the investment cycle. I've been on record saying that for the first time, at least in the last 15 years, I'm seeing completely in sync all the 3 levers of investment cycle kicking in, which is real estate, which is government spending, and corporate capex. And I'm very, very confident that is going to pick up next year, because that it is always preceded by 2 years of very robust profit growth. Building materials, all these forward backward linkages. The only change, for example, we've been fairly constructive on commodity cycle because we believe that China not being part of the broader global market means that the equilibrium prices of metals will be higher now than what they were previously. But now, given what we are facing about in terms of the complete property meltdown in China, we are less constructive on commodity. We don't have a great view over there. It's a better way to put it across. Outside that, but yeah, very bullish on something like autos, banks, forward backward linkages to real estate stocks. A lot of ideas. We are short on money, not on ideas.
I like that. Okay, let me probe a couple of them before we let you go. Autos. The problem, as I see, Nirav, and again, difficult to predict this, but at times market likes what it likes, right? And even if the other side is available at a really good earnings yield, valuation, what have you, the market doesn't tend to like it. And the example is stark: Tesla versus the other 10 automakers. Now in India, we're starting to see, I'm not saying the same will happen, but I'm saying on the yarn that is being spun, we're starting to see that, right? There is a distinct Tata Motors versus Maruti story out there. EV versus not a believer or not EV. In the two-wheeler space, I mean, Rajiv Bajaj's comments are right out there. But that notwithstanding, maybe Ola Electric has not delivered anything till now, but they're certainly producing and getting orders by the dozens. So how do you juxtapose your positioning between what is called the fancy of the markets versus what is attractively valued, and why?
Very good question, and this is something that we've been debating internally as well. So let's try and break this down into parts. So one thing is very clear, that EV is the future, right? So we are only debating the pace of adoption, whether it's going to be 10 times in 5 years or 10 times in 10 years. None of us know, because a lot of the parts of the ecosystem has to kick in, number one. Secondly, the second point to look at is that who is going to dominate in that EV space. Now, let's say, for example, let's come to cars for example. In cars, in India, 70% of the volumes are less than 7 lakhs. It is impossible for you to electrify at a price point of 7, 10, 14 lakhs, right? So 14 lakhs, I think, is where I think Tata, Nexon, seems to be priced at. So I believe that in India, there's going to be a step. We are going to come at hybrid, and then you're going to move into EV, where I believe that Maruti has a great competitive advantage. Just because Maruti is not talking about it doesn't mean that Maruti doesn't understand what to do about it. Number one. So I am extremely clear that, and the way we look at Maruti is that you look at Suzuki and Toyota together. So they've got enough access to technology and stuff like that. Now let's come to two-wheelers. That is more interesting. Two-wheelers, you're the largest market, right, in the world. Secondly, they've got access to technologies. At least you can argue theoretically that when you look at the global auto markets, it is not only electrification or the manufacturing technology, it's also software. So there is a mobile phone, there's a software. And the question is that Tesla, for example, also owns a software which is full self-driving and stuff like that. In two-wheelers, you don't need that, right? I am fairly confident. You never know finally what the future is made of. I'm fairly confident that the incumbents will have an advantage. And if you now look at what TVS wants to do, what Bajaj wants to do, they are increasing their capacity 10 times in 1 year, right? It is just that because I'm making tons of money in ICE, I don't want to preempt that conversion. But when I know that this thing is happening, I'm ready with the product. I'm probably ready with the superior product as well, right? So I don't necessarily see that, you will have an outsider coming and disrupting the electric two-wheeler space. I think incumbents probably will end up owning a larger market share, even in two-wheelers, which comes down to the question that you're asking, that when you look at a lot of these two-wheeler companies, and if you're looking at the free cash flow, it was 6 or 7%, I'll be a buyer, because I think that in next 5 years, 7 years, you'll probably have all these companies owning a large part of electric two-wheelers as well.
The small counter to that might be that some of the new age companies have PE money to burn. They don't have the legacy margins to protect. They don't have the legacy ROEs to protect, to show to their investors. And therefore, even if they don't capture the entire market, which is also debatable. You would agree, you yourself said that you don't know how it will shape up. But even if they don't capture the market, they will disrupt the current internals of the incumbents by in a massive way. Is that something that the market might be worried about as well? That even if a Bajaj Auto is available or a Hero Motor is available at the yields that they are, they might not be able to maintain their margin trajectory 2 years out, because if Ola is getting their scooter at whatever, say 99,000, a lakh rupees or whatever it is, Bajaj and Hero can't dream of getting their smart solve EV or electric scooter at 150, 160.
Well, I don't believe that. The question is that what is the source of competitive advantage for, let's hypothetically, right? That is a question that you want to answer. So you don't see any of these newcomers having any great competitive advantage, either in terms of sourcing, either in terms of costing. Now, if you're telling me that capital is going to be the only, the only reason why Ola is going to succeed, I'm almost willing to bet that the odds are less than even 1%. The fact of the matter is that most of these incumbents are also, almost sitting on $1.5 billion of cash. So I'm far more confident about what's going to happen in the Indian market than probably what is going to happen in the overseas market, because Those are different markets. But in India, I think that the newcomers are going to be having a tough time. And please appreciate the fact that all these guys eventually are banking on the private equity funding them, and now increasingly the fact that they are going to be funded by the public markets. And you've seen what has happened to some of these recently listed names, right? When you live on borrowed cash, it's a question of time. At some point of time, it's going to hit you.
Okay. One final question before we let you go. A theme that strangely the market seems to be a bit concerned about is the pace of growth and the longevity of growth in specialty chemicals. You were amongst the earlier ones, and which is I'm bringing this. 1 quarter of a slightly poor performance has brought some of these stocks down anywhere between 15% to 30% or 35%. Are you a believer? Are you a skeptic because of the run-up in valuations? Or do you believe this is part and parcel? It's happened with the best of companies in the past and will happen with some of these as well, but there is a long runway of growth.
Short answer to your question is that you will continuously see this kind of pullbacks happening, especially when valuations run ahead of the story. But nothing on the ground tells you that so all these companies have extremely robust competitive positioning in terms of their specialties. Some of them, all of them, sort of specialize in 1 or 2 chemistries and then look at smaller SKUs and stuff like that. And China plus one is something real. This is not now something that has been delegated only to the pages of the newspapers. But yeah, it's good in a sense that valuations start aligning to the expectations of earnings growth rate. But the story is there for a long time.
Okay, great. Good talking to you. Thank you so much for taking the time out, and have a great week ahead.
You too. Thank you so much for having.
Now, pleasure is ours. Viewers, thanks for tuning in.
Thank you, sir.
Thanks, Prateek.